Let's now have a look at learning objective 4. We've now looked at how to account for receivables. Let's have a look at how effectively businesses manage receivables. As I mentioned earlier, receivables are the lifeblood of many businesses. Many businesses depend on their ability to offer their customers credit in order to close a deal and generate sales revenue. So therefore, accordingly, we need to evaluate how well they manage that overall process. Now, what I would like you to do now is I would like you to answer this question. Using the horizontal analysis, what is the percentage change of accounts receivable from 2015 to 2016? If you can please answer that question right now, that would be great. So how did you go? Well, remember here we're looking at horizontal analysis, which is looking at change across time. That's why it's horizontal, across the horizon. We're interested in the change from 2015 to 2016. So if we look at that here, we can see that the base year was $150,000 in accounts receivable, and the following year had $200,000 in accounts receivable. So obviously it's increased. So it's increased by $50,000 from 2015 to 2016. So accordingly, we divide that increase of $50,000 by the base year, which is always the first year in the analysis, which is 2015 here. So that's 150,000. That gives you an increase of 33.33%. That's the increase in this case, and that's the correct answer. Now, remember that the total assets are not relevant in this case. You don't need the total assets to work out change over time for the accounts receivable using the horizontal analysis. Total assets are not relevant to answer this question. Now, if you were performing the vertical analysis and you wanted to look at the proportion of accounts receivable to total assets, then of course that total asset number would be useful in that case. So let's now have a look at analyzing receivables and how effectively a business manages receivables in a bit more depth. As you know, investors, creditors, managers of business, other interested parties may be interested in how well a business manages its accounts receivable because they are frequently the lifeblood of businesses. So if we look at Chartered Accountants Australia and New Zealand, we can see here that across this particular period, we have an 8.4% reduction in accounts receivable, which is good, which means that presumably customers are paying up faster, and so less accounts receivable are outstanding. This is also reinforced by the case that you can see that net sales over the same period increased. So we have an increase in net sales, but a reduction in the amount that customers, or members in this case, actually owe. So that's a good thing, and that's what we like to see. It means that instead of waiting for customers, or members in this case, to pay up, they've actually paid up and the business or organization actually has the cash on hand. Now, if we look at the vertical analysis here of Chartered Accountants Australia and New Zealand, you can see that the accounts receivable in 2014 are 5.5% of their total assets, whereas in 2013 they are 6.4%, which is consistent with what we saw on the previous slide, which is the reduction in the amount of accounts receivable over time. Not only is it reducing, but it's also reducing as a proportion of total assets. So again, this seems to be a good thing. Customers are paying up sooner, the business has its cash faster, and therefore is in a better position. Bad debt expenses are extremely low in this case, right? So yes, they've increased from 2013 to 2014 from a proportion perspective, so the proportion of bad debt expenses to our total revenue, but they are still extremely small, right? So in the case of 2013, we had $8,000 in bad debt expenses across a total revenue of $96 million. So a very, very low amount. So looking at this information, do you think the direct write-off method to account for bad debts is appropriate for this particular organization? And the answer is yes, it is appropriate, because I think that the bad debt expense as a proportion of the business's overall performance, for example, sales revenue, is a relatively immaterial amount. And so therefore, accordingly, directly writing off bad debt expenses would be acceptable in this particular case. Now, why are the bad debt expenses so low? Well, it could be the case that this organization is really good in following up members or customers in paying. It could also be the case because they are a professional organization, and if members don't pay, they are in effect not members, and therefore they can't practice as professional accountants, and so therefore they won't be able to earn an income. So therefore also makes sense that they pay up. Now, one of the ways in which we can analyze a business's effectiveness in managing accounts receivable is to look at the receivables turnover ratio. So basically, the receivables turnover ratio looks at how quickly a business collects its receivables from customers. So that is, how many times during the period does the business completely collect its average amount of receivables that it has on hand. So what we do in order to calculate this is we look at the business's credit sales for the period, so a company's credit sales for the period, and we divide those credit sales by its average net receivables for the period. So average net receivables calculated by the beginning receivables plus the ending receivables divided by 2. Or the ending receivables for the prior period, which are the beginning for the current period, plus the ending receivables for the period we're looking at, divided by 2 to get the average. So you get the average net receivables, you divide that into the credit sales for the period. That gives you the number of times the business turns over its receivables for the period. Now, you could also look at how many days it takes customers, on average, to pay off receivables that are due. And so all we do is we take our accounts receivables turnover ratio that we calculated, as I explained here, and you divide that into 365 days, so the days in the year, and that gives you, on average, the amount of time it takes customers to pay up. Now, of course, this is assuming that your accounts receivable turnover ratio relates to a period of 1 year. If it relates to half a year, then obviously you need to half the number of days in order to determine the actual days that it takes customers on average to pay up. So what I would like you to do right now is I would like you to determine what the receivables turnover ratio is in this particular case. So beginning and ending net accounts receivable for the period are $40,000 and $60,000 respectively. Net credit sales revenue for the period is $150,000. What is the accounts receivables turnover ratio, or receivables turnover ratio for short? So to answer this question, the first thing that you want to do is you want to calculate what the average accounts receivable are. So if the beginning accounts receivable for the period is $40,000 for the period, we have 40,000, and the ending is 60,000, and we add those two together, we have 100,000. We divide by 2 to get the average. That gives you an average accounts receivable on hand for the period of $50,000. You then take that 50,000 and you divide it into the 150,000 in credit sales for the period, to give you the accounts receivable turnover ratio, which is 3 in this case. Another ratio that you may want to use is the allowance ratio. And the allowance ratio allows you to compare the bad debt allowance you have with the gross accounts receivable that you have. Right? So all you do is you have allowance for bad debts for the period divided by the gross accounts receivable for the period. So you can calculate this ratio by referring to information that is available in your balance sheet, and in particular, the accounts receivable section of your balance sheet by looking at gross accounts receivable, the allowance for accounts receivable, putting together all that information into this ratio and calculating it. So a higher ratio indicates that a company expects more receivables to be uncollectible. Is this a good or bad thing? As I mentioned earlier, this depends on the nature of the business. If the business is really, really thorough in screening out all customers that may not pay, then you'd expect this to be really low. If they promote their business to offer easy credit to customers with bad finance, you would expect it to be higher. That's not necessarily a bad thing, provided the business is aware that this will happen and manages it through its pricing strategy to cover those bad debt expenses expected.